Well, there is some good news on the horizon. Your house is worth more now that you sold it.
Thank you. Closed escrow just in time for the swing up.
If I'm not mistaken, Ryan Dalzell, our resident real estate expert here on the Big Biz Show, told you, I believe, Ryan, wasn't it 3 weeks ago? Don't sell, don't do it. Just
wait a little bit.
Yeah.
So what is, it's interesting. So this week, this week we saw a bunch of stuff happen. We had new home sales.
Yep.
We had existing home sales. It all looks good. So give us an overview of what's happening nationwide with these reports. Is it for real, first of all?
Yeah, it is for real, and I mean the best part about it is sales are still way down from where they were at the peak, the volume of sales.
Okay.
But prices, supply and demand, we got a really healthy supply and demand, and so prices are creeping up and creeping up in a sustainable kind of healthy way.
Are there better areas of the country than others? In other words, let's say, is New York better than, let's say, Florida, or is California better than, let's say, Colorado? Or is it regional like that at all?
Yeah, it is, and it's a couple things. I mean, it's going to be the new construction has been way, way, way down. So as long as you don't have too much land, the new construction isn't, the supply isn't too strong. Yeah. To affect that supply and demand, and jobs. I mean, the job markets, the places where
you don't want to build a house where no one's going to have a job to.
How good is a home value if a person can't get a loan to get that home? I think is my concern. Let's say some of these home value, and I always tend to think of terms like New York City and Dallas and L.A. and even San Diego. But I'm talking about, we've got several affiliates in Dallas-Fort Worth area, and that's a very high DIG real estate area. With respect to that, so let's say you see home prices moving up in the Dallas-Fort Worth area to the point where, let's say, the median home price there is now, let's say, $300,000. And let's say some of the higher end homes are in the $600,000 range. If those people put down 20%, they're still looking at a $500,000 mortgage. Isn't that above the threshold, or is that still within the threshold of getting conventional mortgages?
I mean, it's above the FHA threshold, but it's still, I mean, the surcharge, if you will, on the mortgage above that is still very low. Right. So, I mean, you're okay. So you can't get 3.5%; you get 4%.
Yeah, big deal. Yeah, right. I want to talk about this. I want to talk about how you were affected, because you made a comment before we got on the air here, how it's great for the consumer but not so great for realtors.
Well, yeah.
How does that work?
Well, hey, I'm not asking.
Well, you're both.
I'm not asking.
But you're both though.
That's
you're
true.
a consumer and you're.
Yeah.
It's because of inventory, right?
It's just inventory. I mean, for here in San Diego, I just saw the latest numbers. We're down 50%, 50, on inventory from a year ago. I mean, that's huge.
That's good news, though.
It is good news
for the market. That's the supply and demand you're talking about.
For both buyers and sellers, I think it has brought things back into equilibrium.
Yeah.
For realtors, it just means you're not selling as many homes if there's not that many inventory. Right. But it's also created an opportunity. We've talked about the investors before, and it's a have and have not market for buyers and sellers, and in some ways for realtors.
It's another good time to get in.
Yeah.
Low rates.
Yeah. DalzellGroup.com, by the way, is Ryan's website, Dalzell Group Real Estate. He's based here in Southern California, but comments for us across the country. It's funny, and you've mentioned this before, fashion and retail sometimes leading edge East Coast to West Coast. Sometimes real estate, it seems, over the past couple of years, leading edge West Coast to East Coast. So as goes the U.S. Housing market, goes the U.S. economy. I've said that for some time now. Here in California, which has been a real issue for jobs in this state. It's almost like California is its own island with a moat around it sometimes from the rest of the union. But California's GDP is one of the largest in the world, chiefly because I think real estate's got to be part of that. How's the real estate market looking here in California?
No, it's looking good. Again, the supply and demand. The land. I mean, the coastal areas are doing definitely better than the inland areas. I mean, those areas still. Kind of like Vegas and those type of cities, there was a lot of land to build on, and so it was overbuilt, it was oversold, and so the recovery back. I mean, everywhere though in California, you're seeing increases in prices, but it's going to take a long time to get back to where the prices used to be.
People used to ask, it's funny when I got into radio and we started talking about equities, in other words, securities. And I would have real estate experts on, and there was almost this mentality of I'm either going to be a stock guy or I'm going to be a real estate guy with my investments. And the historical projections were that you could count on somewhere between 8 and 10% per year increase in the stock market and in the real estate market.
Right.
And honestly, if you looked at it, it was very even over the, some people, we had those great years in
real estate was zoom.
Well, we had those great years in the stock market. They were crazy. And then the market pulled back and real estate seemed to be safe. But overall, if you look at the last, 40 years, it's pretty even. You think we'll see those 8% per year days again in real estate in this country, or is that going to take a while to get to that point? Are we going to inch along? I mean, how do you guys calculate, the increased value and the increased wealth effect from that value over the course, let's say, of the next 5 years?
Right. Well, I mean, you've always got to take into account that people are not putting down 100%. I mean, there are cash buyers, but there's that leverage. The bank has taken on that leverage. And so even if you get a 3% or 4% increase in prices,
it's only 4% of your equity.
Exactly.
Right.
Exactly.
But still, I think
so that's significant.
I think so too. I mean, if for a while there we weren't getting any increase. In fact, we were getting decrease.
Right.
So,
yeah.
So
that's right. When I got in,
the interesting part, though, is that based upon Wall Street Journal, Market Watch, and CNN reporting Monday, that the housing market values are where they were approximately in 2003.
Yep.
That's the best. Obviously, that's 9 years. 2006, didn't we peak in 2006?
Yeah,
something
2006.
like that. That's not bad. 2003 isn't bad. I mean, we've gotten back, a lot of our gain or a lot of our losses at that point, right?
Yeah. The best thing that's happened over the last year that we've seen is that these increases are coming outside of any stimulus. In 2009, we had the stimulus, and it propped it up. 2010, and then it dropped back down.
And what does that teach us? We've had this conversation on this show before, Ryan, and I want to continue this after the break. But it's interesting how much stimulus has been pumped into the stock market and how little stimulus is pumped into. It's almost like they did the one stimulus for the housing market, and it didn't work, and they said the hell with it.
Right.
And that stimulus was TARP, Troubled Asset Relief Program. So, and it didn't work. I mean, it was fumbled. Remember the old where's the $700 million?
Where's the beef?
Where did the money go?
Yeah.
I have my own theory on what happened with the money. I think they pumped the money in the stock market. The stock market went up. I think they used it for quantitative easing because the market went crazy.
Yep.
But it's interesting that they didn't mess with the housing market since then. And look what's happened.
I know.
Leave it alone. It's not overbought. Yeah, exactly. It's not overbought. It's not oversold. And it has recovered on its own. Now, it was painful.
Right.
And it was a long, painful thing that we had to go through. Some might say that we should go through a very similar type arrangement with the stock market and our own economy. We'll see what happens there. Ryan Dalzell is our guest. We're going to get more from Ryan after the break. I want you to go visit his website, dalzellgroup.com. If you're listening to us on radio, that's DALZELL group.com. More real estate stuff. We got to talk about mortgages. All my emails to you are all about mortgages, buddy. Big Biz Show, bigbizshow.com. Ryan Dalzell here is from Dalzell Group. He is our national real estate expert on the program.
Do you play guitar or anything?
I have zero musical ability.
Wait a minute. Say, you have zero musical ability?
Zero.
I'm not sure about that, right?
Got nothing.
I can carry a tune. My wife said yesterday.
I've seen you do interpretive dance before.
Well, okay. Does that count?
With the ribbons? That was
talk to us. Okay, so tell us the state of mortgages. In an article today out of Scottsdale, Arizona, after half a decade of tightening mortgage guidelines, banks are starting to loosen up. Federal Reserve conducts a quarterly survey of its member banks, and last quarter, not a single responding bank reported having tightened its mortgage guidelines. A prime borrower now defined as one with a well-documented credit history, a high credit score, a low debt-to-income ratio. 53 banks reporting to the Fed survey, and none said that mortgage guidelines tightened. In fact, a few saying they're loosening those those guidelines. All right. Now, when you see stuff like this, is this BS or is it actually real?
No, I think it's true. I mentioned off break that we had a lender in a meeting yesterday kind of talking about a new program for doctors and attorneys that lends up to 95% loan to value. So it is loosening it up. It's loosening up for the right buyer. You still have to be qualified and still have to be able to show income, which you should.
The lenders figure, well, people are always going to get sick, so doctors are safe, and they're always going to sue their doctor for trying to make them better.
So attorneys are safe.
Attorneys, yeah,
there you go.
That's good.
That's good.
Yeah,
maybe liquor store owners too.
Because
people are always going to.
They would easily loan to a liquor. If you own a liquor store
or a laundromat,
95%, you're always going to have dirty shorts.
There seems to be this stigma that goes along with private equity, and that used to be called, I think, hard money.
Hard money, yeah.
And hard money, real hard money these days would probably be 12% interest with a couple of points attached.
Mm-hmm.
Oh,
a
that's
little,
like
more like 10, but
that's
yeah,
borrowing
but
from
still,
your buddy.
10% interest.
still
Yeah.
up there, yeah.
10% interest
Yeah.
was not a bad word in 1988.
Right.
10% interest was not a bad word in 1995, I don't think.
Right.
You have to take it in perspective. I guess at some point, if you want to take advantage, if the example I was giving Ryan on the break was there was a gentleman that had called the program at one point. He had a $250,000 a year annuity, meaning that was paid to him with after-tax dollars through his insurance company, but
Nice.
it wasn't W-2 income. Okay. In other words, he doesn't report it as income tax. It was already because he paid tax on the way into the annuity,
okay.
so the return doesn't get taxed. So it's not income. It's just an annuity. Well, he's living off that money. That money's coming in every month. He's paying. He's going on vacation with it. He's paying bills with it. He's buying groceries with it. He's doing whatever he wants with it. Yet he couldn't get a standard loan because of the way the guidelines are now. If you don't have W-2 income,
right.
he had great credit report and all that stuff. I got to believe that some of those are going to be the first things that change.
Yeah.
Because those are kind of the unreasonable. We're underwriting for the regulators versus underwriting for the
consumer,
for the consumer. And I think that's an issue. Is there a time frame whereby you think the mortgage underwriting is going to catch up with the increase in housing? Because wouldn't it be great if they, at some point, the vortex came together where housing prices are up and now you can get a loan again?
You know, I think it's more about them seeing, and I think it's going to take a couple of years, well, maybe not that long, but we've already had almost a year of price increases. So I just think they need to see a little bit of that trend.
Yeah.
They need to see that the distressed inventory that everyone was so worried about is being managed and is not going to all of a sudden, because it's all loan to value. It's
Don't
all
you think that
them.
folks have learned their lesson, though? I mean,
I do,
it's been a long, hard 4 years. It's been 4 years. It's a half a decade almost. Next year will be half a decade. 5 years come March of this, and that's a long time. I think people have got to have learned their lesson at this point. The other issue, too, that I find interesting is that all those people that lost their jobs and couldn't pay their bills back in 2008, 5 years has passed. A lot of those credit reports don't even matter anymore.
Right.
You know, all that, they filed bankruptcy 5 years ago. There's an extra reason, or they had a charge off or whatever on their credit, so their credit was good and then it went bad. They're recovering from that now.
Right.
5 years down the road, that's a long time for a bet. Like if you had a bad credit thing, 5 years is a long time.
Right.
Isn't it interesting how they're all kind of coming together again? So you went through that pain, but it really didn't matter at the end of the day anyway because your credit was going to restore itself in the course of 5 to 7 years anyway.
Yeah,
So,
I mean, even a bankruptcy is 7 years. So, I mean, worst case scenario, you're saying 2008, a lot of those people faced bankruptcies and give it another
keep
year.
your finger on the pulse, buddy. I appreciate it.
Sure.
Ryan Dalzell, DalzellGroup.com.
You're giving me a great idea.
Oh, no. There's another great idea for us.
Bankruptcy would be bad. 7 years.
Do not
Boom.
file bankruptcy.
No?
That's
All
a
right.
bad idea.
All right.